Imagine investing $10,000 into a company that sells dog food online, and watching it drop to $0 in a year. Now imagine everyone around you doing the same, and thinking they're financial geniuses. Welcome to the dot-com bubble, the moment in history when the internet became a religion, and greed its profit. It's the late 1990s. Bill Clinton is president. Everyone's afraid of Y2K. And if your startup ends in .com, you can raise millions, even if your business plan is just a napkin with the word internet circled 3 times. This was the birth of the digital gold rush. The internet was new, mysterious, and full of promise. Investors saw it as the next industrial revolution. But instead of funding steel and railroads, they threw money at sock puppets and grocery delivery apps. Literally, enter pets.com. They sold pet supplies online. They burned through $300 million. They had a Super Bowl commercial. And they were completely out of business 9 months after going public. But for a while, they were worth hundreds of millions, all because .com made people lose their minds. The logic went like this. No profits? No problem. No revenue? Still fine. Because the internet is the future, and the future doesn't need boring things like business models. Valuation? Who cares? As long as your logo looks good on a baseball cap, VCs were ready to write checks the size of small countries. And Wall Street? Oh, they loved it. Tech IPOs were the hottest things since Beanie Babies. Startups with zero earnings were valued higher than established Fortune 500 companies. It was financial fantasy roleplay, and no one wanted to log out. Companies like Webvan promised to revolutionize grocery delivery in 1999. They raised almost $400 million, built out massive infrastructure, and then collapsed in less than 2 years. Why? Because, shocker, there wasn't actually demand for what they were selling. But hey, at least their warehouse looked cool. Meanwhile, your average Joe, the plumber, the teacher, the bartender, was buying tech stocks like scratch-off tickets. Why not? Prices were doubling in months. People quit their jobs to day trade from home. .com millionaires were everywhere. Until they weren't. By March 2000, the fantasy started cracking. The Nasdaq peaked, then fell, and kept falling. Suddenly, the party was over. No more funding. No more IPOs. No more sock puppets. just silence and bankruptcy filings. From 2000 to 2002, $5 trillion in market value vanished. That's trillion. With a T, companies imploded, fortunes evaporated. And the phrase, .com, went from trendy to toxic in under a year. But here's the plot twist. The internet itself didn't fail. Only the hype did. Sure, Pets.com crashed, but a few years later, Amazon was thriving. Webvan died, but eventually Instacart made it work. The survivors? They weren't the loudest. They were the smartest. They focused on value, not vibes. So what caused the bubble? It wasn't just tech. It was the perfect storm of overconfidence in new technology, cheap money and eager venture capitalists, FOMO-fueled retail investors, and a collective belief that if you just built it, profits would magically appear. Spoiler, they didn't. But the lessons? They stuck. Don't confuse innovation with inevitability. Don't invest based on hype. And if your business model relies entirely on get big fast, you'd better hope fast includes profitability. Or at least the ability to survive until next year. The dot-com bubble wasn't just about financial loss. It was about blind optimism, how a whole generation mistook access to the internet for access to infinite wealth. Turns out, technology changes fast. But human nature? Not so much. And in case you're wondering, yes, there's probably another bubble inflating right now. Different buzzword. Same story. Same hope, same hype, same cliff.